So you've finally done it. You've snagged your dream retirement villa in Mykonos or that cozy casita in Puerto Vallarta, but then the IRS comes knocking like your greedy cousin. What do you do?
Today we're dishing with expat tax expert Miele on what actually happens when U.S. retirees, especially fabulously gay ones like you, collect Social Security, dip into retirement accounts, or even pick up a little side gig abroad.
The big question, do you have to pay double the tax to Uncle Sam and your retirement country? This is Queer Money episode 615, and today we're untangling this knot and saving you some coins. Retirement abroad isn't a dream. It's a plan, thanks to the optimized Portugal Golden Opportunities Fund. Stay tuned. So welcome to the show, Michelle. We are really excited to have you on this episode. Folks, one of the reasons why we are doing this episode is, as many of you know, and probably have the ways that you have found us recently, is over the last year or so, John and I have been talking a lot about moving abroad, whether that's retirement or because of the political climate. And a lot of you are very interested in this. And one of the most common questions that we get when we talk about a country or a city or a series of cities is, well, what about the taxes? How do I plan for taxes? What do I do if I'm an expat or a foreigner, or as we like to refer to us as immigrants? When we move to another country, we're planning to stay there and you're going to file taxes. You are now an immigrant. And so we know that tax planning is unique to every single person in their familial situation, right? How much you're earning, what your income sources are, where you are living, how you file your taxes as a couple, filing jointly, single, all of those factors play into the answer to those questions. What about taxes for me? And so it's really difficult to, in the comments on social media or even on these YouTube videos, to say, here's the answer for you. And so
social media doesn't have all the answers to everything I need to know.
Exactly.
Very confused.
So we've invited Michelle on the show because she has a specialty that will help us understand this at least a little bit more. We want to give you a taste of what you should be thinking about when you're looking at moving abroad. And depending on your situation, we're going to try to cover several examples. We're going to run through 3 real life examples, or fake in real life examples, but examples that you may be able to see yourself in. So before we dive into this, Michelle, thank you again for joining us. Would you mind please explaining to our listeners and viewers what it is that you do and why there's a specialty for it?
Because it's hard.
Yes, it can be very hard. So I have always been a traveler. I love traveling. And when I started my own business 2 years ago, it was kind of a natural fit to work with expats that I've met along the way. And my company is called Director of Paperwork. We do taxes, we do tax planning, bookkeeping. And this specialty is super important because as long as you're a U.S. citizen, you're probably going to have to file U.S. taxes. And finding someone that understands those specific credits and exclusions, is so important.
Yeah, I think that especially for those who are wanting to leave the country for political reasons right now.
Country? Is that what
you're saying? The country, yeah, the country. Yeah. For political reasons, a lot of them are probably thinking, how can I not have to give this government any more money than I need to, right? So maybe that's probably one of the first questions that we have for you is, if I decide to leave the country, do I have to still file taxes in the U.S.?
So yes, you usually have to file taxes in the U.S. even if you leave, but filing doesn't necessarily mean that you have to pay or that you owe. So it can just depend on your tax situation, but some countries you don't have to file there, but you'll have to file in the U.S. And your second obligation is always the U.S. tax. The first is where you're living.
Yeah. Gotcha. So folks, before we go any deeper, if you're watching us on YouTube, let us know what your main source of income will be in retirement. Is it going to be Social Security, IRA or 401k distributions, Roth, pensions, what have you, part-time work? Let us know in the comments of how you'll be generating income. So you just said something right there that piqued my interest. In certain situations, you might not have to pay taxes. Tell me more about that.
So it depends on where you're living. So some countries, like there is no tax, like fully tax-free countries, UAE, Cayman Islands, Bahamas, Those are some examples. And those countries, you don't file any taxes there. You don't pay any taxes there, but you'll still have to file your U.S. tax. So I guess depending on your situation, you may or may not owe anything to the U.S. But I have a lot of clients who maybe they don't pay anything where they're living and they just file in the U.S. and they don't owe anything there either.
Interesting. Nice. It's kind of like living in a no income tax state, right? So for example, when we lived in Nevada, we didn't file a state income tax because they don't have a state income tax requirement there. We did pay a lot in sales taxes, but they're going to get you. But it's kind of similar that there might be some countries. So what types of income do I have to pay taxes on if I am living outside the United States? Or what kind of taxes might I have to pay in the foreign country?
So I guess the same as here in the US, if you're working, your business income, your pensions, your IRAs, your investments, your interest. I guess one thing, your Roth IRAs can sometimes be taxable in a different country, even though they're not taxable in the US. So that's one tricky little situation that you always have to keep in mind.
Oh, and how would you find out about that exactly? Because I think that's actually quite surprising to me, and I imagine most of our listeners and viewers weren't aware of that.
Yeah, so it depends on the country that you're in. And so lots of them, they don't like that Roth setup, and they just say, yeah, it's income, you earned it. Even though you already paid tax on it before, you're taking it now. So you don't always get that benefit.
Gotcha. Is there a strategy maybe to avoid that then? Like maybe I'm thinking of like 72T distributions, although that wouldn't apply to a Roth IRA, right? Or like a Roth conversion. You've already done that. Can you just put it into your bank account?
No. Well, I'm wondering, would you want to maybe, because you don't have required minimum distributions with Roth IRAs, so you may want to delay that in the event that you move out of that country into another country where you do, if you have another source of income, obviously. Is that?
Yes, that would be the goal. Like you would try to plan it, maybe take a little bit of time so you can reduce your taxes, or, take it before you're leaving the US, after you come back to the US, so that you can kind of strategize what would work best.
Yeah, interesting. That's why we have accountants, right? There's all of these different nuances. So we've heard that there are some countries that have tax treaties with the U.S. So does that mean that if we have a tax treaty between the country, then we don't have to file taxes in one of those countries? Or how does that work?
So that is not exactly what that means. So that usually means that you won't be taxed twice on the same income. So the U.S. taxes your worldwide income, and most other countries are also going to tax your worldwide income. So first you pay taxes where you live, and then you pay taxes in the U.S. second, if you're living outside of the U.S. So countries like Canada, UK, Germany, France, Mexico, and Brazil, those are all tax your worldwide income. And so does the U.S. So those treaties help you to make sure you're not paying double the taxes in both countries.
So if I'm understanding correctly, then if, say, we're living in France, we pay our French taxes first,
Yep.
and then whatever difference we may owe the U.S. government is what we pay the U.S. government.
Correct.
Okay, so you're not paying twice. So you may only be paying more in taxes when you're living in another country in some situations, if you pay little taxes here in the U.S., right?
Yes, exactly.
Got you. So France is going to charge you because you want that healthcare.
Yeah. Yeah. So you made a really interesting point. You said that you file your I was curious about this. You file your taxes in the country in which you're living first,
Yes.
as the way to kind of establish your basis of what you would pay for taxes in the country. In this example, it's the U.S., but of your country of origin. You might have, say, folks from Canada who have moved to Mexico. And we know there are viewership and listenership is worldwide. But you're basically saying you always want to file your residency taxes first, and then file the other taxes. And you bring up a good point. You may be living in a country where the tax rate is higher in that country than in your home country. And in that case, you're
probably not giving Uncle Sam
well.
a whole lot. No, you're probably not giving Uncle Sam a whole lot, but a lot of the reasons why people want to move to these other countries is to get better, in lots of cases, healthcare.
Yeah.
But you got to pay for that. Is that correct?
Yeah, that's right. So sometimes I've seen it a few times, I guess specifically Spain, Portugal, Germany, usually European countries that have those extra benefits. You might end up paying more taxes than you would if you lived in the US, but then you're under their jurisdiction, you get their benefits, and then in those cases you won't pay US taxes and you'll get credits, and those can even carry forward for several years. So if you don't use them all, if you end up paying more, we can carry it over. So if you end up moving, you can still use that tax that you paid in the other country.
I'm sorry. Can you elaborate on that? So you're saying we would possibly get credits in a country like Spain or Portugal? And what does that mean exactly? And how can I apply that to benefit me in the future?
So that means that if in Spain you owed $1,000 and in the US you owed $500, we would take that $500 and offset, and the other $500 we would carry forward till next year. So maybe if your tax situation changes, we can still use that to offset your US tax later for up to 10 years.
Oh,
it's kind of like capital gains losses that you can carry those forward as well.
Yes, exactly.
It's like a little bank account.
Yeah.
Again, why you need an accountant to help you with this stuff, because
Yes.
You never would have gotten this answer from us if we just commented on YouTube.
No.
Instagram.
So I know that this is all really kind of complicated, and you gave us some examples here of countries that have treaties with the U.S. What about countries that don't have treaties with the U.S.? What happens there?
You can still take tax credits. There's just a little bit more nuances. So I guess in some countries, if you're paying Social Security in Spain, let's say, then you won't have to pay Social Security on that same income in the US. But if they don't have a treaty, it could, you might be subject to paying into their pension system and ours as well.
So there is the possibility, in some cases, you could be double taxed.
Yes. Usually it's not, because we can take those credits and we still get to take advantage of those even if there's not a treaty. But I guess there's certain types of income that might be double taxed.
Gotcha. Again, why you need an accountant to tell you which ones are. So what would you say, if you've worked with a number of clients who are doing this, what would you say are some of the common misconceptions or maybe pitfalls that people find when they have moved abroad and maybe have not planned ahead for this, or they maybe are now doing their taxes and then all of a sudden something raises its ugly head and they're surprised?
Yes. One is definitely what we mentioned already, that you might end up paying more in taxes, especially in those European countries. The second, I would say that people sometimes forget, or they don't know that they have to pay US taxes when they leave the US. So I have a client who left the US 10 years ago, 20 years ago, I think, and didn't pay taxes. But there's a special process and you can get caught up. It's basically like the IRS, they let you say, oops, and then you can fix it and get caught up. So it's like an extra special process for expats who maybe forgot to file, didn't know they have to file. And then, when they realize, they're like, oh no. But yeah, they can take care of it.
I saw you didn't have to pay taxes for 10 years.
Yeah.
Were they filing taxes in the country where they were residing?
Yes, they were.
Okay, gotcha. Okay. Phew.
They're on the lam. They're running from tax haven to tax haven, trying to.
Well, government's chasing them down.
Yeah. I mean, we've Cayman Islands, right? That's their people are known for taking their money to the Cayman Islands to try to avoid paying taxes. Right?
Yes.
So, folks, I did mention earlier that we were going to cover a couple of real life examples, and we gave these to Michelle in advance because, as we said, this is complicated. So we're going to share 3 examples here of different family types and different income situations and different age groups so that you can get a picture of this. And so, Michelle, the first group we're going to talk about, or first family we're going to talk about, is a family that is married filing jointly. Both of the individuals are under the age of 65. They are not taking Social Security yet. They do have an online business that is domiciled in the US, and let's just say they're earning about $50,000 from that, as well as they're withdrawing money from their retirement accounts. Specifically, let's use IRA accounts that are non-Roth accounts, so like money that was previously in a 401k. And this couple lives in Mexico. So can you give us a picture of what their tax situation might look like?
Yeah. So first, Mexico is one that does tax your worldwide income. So it doesn't necessarily matter that your business is domiciled in the US, you might have tax on it. So I first always recommend you talk to a local tax professional, figure out what your tax obligation is there, and then come to someone like me, with US tax experience who can kind of help you offset and balance. So Mexico, what they're probably going to tell you is that those IRA distributions are not going to be taxable in Mexico, but they are going to be taxable in the US. As far as that online business, I guess this is kind of the part that gets a little bit sticky. If you have an LLC, there's a few other countries that they don't really like that LLC status, and they see it like a corporation. So you always want to make sure that if you are moving to a country like Mexico and you have an LLC, that you really look at how that's treated, because they are going to see that as a corporation, and it's not going to be the best tax benefit. So if you're fully self-employed, if you don't have that LLC, then we can claim that earned income exclusion. So it's possible that you won't have to pay US tax on that part, but you'll just have to pay those self-employment taxes, so Social Security and Medicare, on that $50,000 of income.
Gotcha.
So in that scenario, we know a lot of online businesses who do have LLCs, specifically in S-corp, right?
Well, we know some who have them as S-corps because they have either full-time or part-time staff, or they've set it up that way so they can pay themselves.
So what would be the most beneficial structure for like Mexico?
I guess probably it would depend on if you have other employees still, but that S-corp status, it's going to be taxed as a corporation, and it's not going to flow through to you anymore. They don't really like that flow through, whether you're a single member LLC or the S-corp.
Gotcha. Okay. All right. Well, that makes sense. And that we did this specifically because, to be honest, we have a number of people in our community, the personal finance community, that are run online businesses, YouTube channels, and
from Mexico.
Yeah, exactly. All right. So let's move on to another example. And in this case, we have a couple that is married, filing jointly. They are over 65. They are taking Social Security. And they have a net income from Social Security of about $3,500. They are fully retired, and they are withdrawing $75,000 a year from their IRA accounts, again, taxable. And in this case, they're living in Portugal. We seem to be hitting some of the high-cost countries right now.
Yeah.
These are really popular countries, and
they are.
There are people who want to move where they want to move. So
yeah,
it is. Yeah. Portugal is seen as a high tax country. So they are going to tax your Social Security, and they're going to tax those IRA distributions. You'll then report that same income on your US tax return, but we'll take those credits. And so more than likely, you won't have a US tax obligation, but you'll have to file. And then you'll end up paying those Portugal taxes instead.
Gotcha.
But in a lot of cases, you'll probably pay net more in taxes in Portugal than you would here in the US. Is that a good assumption?
Yes, most likely.
Yeah.
And did you say, I think you said earlier that somebody was surprised that they had to pay for taxes in another country? Where do they think how they're paying for their benefits?
Well, yes. I mean, I guess it can be shocking. I think when I was looking this up, Portugal, tax rates go all the way up to 48%. That's higher than the highest tax rate that we have here in the US. So, depending on your income levels, you might end up paying more.
Yeah, but back when America was great, the top tier, the 1%, paid 90%. So, but we don't seem to be talking about that these days.
I will say we did talk with somebody who lives in Portugal, and they said that healthcare costs in Portugal are about 1/10 of what they are in the United States for going to a private doctor. And
so you're paying that through the taxes
right
up front and not necessarily on a per visit basis.
Right. Well, and we also know that I think it was Fidelity came out and said that the average couple in retirement will spend around $168,000 just on medical care. Just think about that. If you cut that down to 10% and you're spending only about $16,000, $17,000 versus $168,000, that's a lot of taxes that you might have coming your way if you are living there.
Yeah, but for them, they're not earning. Their only income is from Social Security and their IRA distributions. So they're probably not going to be in that higher tax bracket, right? The highest tax bracket. So it might actually be beneficial for them in the long run to be in a country like Portugal.
Yeah, and I think this is the important point is to in advance talk to someone like you, Michelle, who can take a look at the strategies that they plan for distributions from their various income sources and say, okay, this might put you in this tax bracket, or this might be the strategy that we would use to lower your taxes in both countries.
Yeah, exactly. Because just because we're paying higher taxes doesn't mean like our cost of living is higher. You know, we might be paying less in rent, or paying less in food, or paying less in healthcare. So those things can definitely offset.
This is why it's amazing to have a retirement calculator to work with and manipulate the numbers. We'll talk about more of that later.
All right, our third and final example, we're going to go with someone who is single, who is over the age of 55. They are not taking Social Security. They are withdrawing $1,500 a month from their retirement account. But they also sold a home that they had for over 5 years that had $150,000 in equity, and they're using that money, they're spending that money to live off of about $1,000 a month. And they are living in the country of Thailand. That's another popular country that keeps popping up for our community.
Yes, it's a good country. So I guess the first thing we'll address is the sale of the home. So you want to make sure that you sell your U.S. property while you're still a U.S. tax resident, because the U.S. has exclusions. When you sell your primary home, it's either completely not taxable, or you get a much lower capital gain rate. So that $150,000, as long as you sell it before you leave, isn't going to be taxable. If you become a Thai tax resident and you sell it after, that $150,000 is going to be taxed. Most likely.
The whole thing.
Yes. So that's, some people say like, oh, I'll keep it for a few years. I might want to go back. But I guess that can be a pitfall. If you know you want to leave, sell your house, and so that you don't have to deal with that later.
Interesting.
Otherwise, what you would have to then return and establish residence. Well, not establish, you just move back to the U.S., right? And then you could possibly sell it before you bounce to another country?
Yes, exactly. So usually you'd have to be like out of that country for a certain amount of time. Like usually it's 6 months, 180 days.
Yeah, I was thinking there's probably that 180 days. So you're looking at getting a home back in the U.S. for a while and establishing your residency back in the U.S. before you sell.
Yeah, if that's the strategy you go.
That's a really important one, because there are a lot of people that we know who are looking at retiring abroad, but they want to keep a home in the U.S. And so,
looking at all you people with the homes in Palm Springs, that won't be cheap.
Yeah, exactly. All right, and then what about the other income? So we've got $1,500.
Yeah, so that IRA income, you're going to pay tax on it in the U.S. And there's going to be, it's called a remittance rule. So you'll pay tax on what you bring into the country. And so then, similar to what we talked about before, we can offset that tax that we paid against our U.S. tax. But if we're not spending all the money, like if we're not bringing in all the money to Thailand, then, we might not have to pay tax on all of it.
Oh.
What does that look like exactly? Because I'm probably not going to show up with a duffel bag full of cash. So is that like, do I have to keep track of all my ATM receipts and for the government of Thailand?
Yeah, I guess it's usually based on like if you're transferring it into a bank, or they'll look at your credit card transactions. Different countries have different ways to tax it. But I've lived in Colombia for a while, and anytime you make a purchase, you've got to put your cedula number in, and they're tracking every purchase that you're making on credit cards. And so they at least have an idea of what you're spending in that country.
Oh, so if you're spending your money on nefarious things, you probably don't want to do that. You probably, if you don't want the government of Thailand to know how you're spending your money.
Yeah.
If you know why some people like to go to Thailand, maybe they want to establish a Thai bank account and transfer the money in there, then not have to itemize all their transactions. Is that how that would?
Yeah. Yes. And then, you can spend cash, but if it's coming into the country on they can see it come into a bank account, and that's how they would kind of track it.
Yeah.
Yeah.
Okay.
Yeah. And keep in mind, there also now is a new rule in the U.S., right? When money is leaving the U.S., they're looking at it to make sure that it is also, you're not trying to avoid taxes. And there's the potential, I think, now of a 2.5% to 3% fee or tax on top of that. So we probably should save that for a completely different conversation.
Yeah.
Yes, that is a different conversation, but that is true. It's mostly for that specific rule is targeted at people who are working within the U.S. and sending money to their families, like back home.
Oh, gotcha. Okay. And then just to be clear too, everything we've talked about is you're just expatriating to another country. You're not renouncing your U.S. citizenship and becoming a citizen in another country. That's a whole different ballgame, right?
Yes, it is.
Okay.
Yep.
Yeah. Well,
anything you think we might have missed that you want to cover before we wrap it up? Any important caveats or?
I think just making sure you plan ahead, getting this stuff addressed before you leave, before you decide to move, figuring out your plan is a good idea. So that way you don't, have surprises when you get there.
And I'm curious, it would be great for, obviously you want to have an accountant both in the U.S. who understands expat taxes, but also you mentioned earlier having an accountant in the country of where you're going to reside who understands that as well. Do you have contacts in other countries, peers in other countries that you can refer our listeners and viewers to if they need?
It depends on the place. I have a few people that I work with, like with my current clients. And so it just depends on if I have someone there. But I definitely work with people in other countries so that we're all on the same page.
Nice. Cool.
and once again, Michelle, how can folks, if they're interested, contact you?
Yeah, and they can find me on Instagram. I'm at Director of Paperwork, or you can contact me through my website. It's dopaperwork.com.
And we found Michelle through our Happy Gay Retirement Facebook community. We posted some things in there, I think, as well as Mark Goldstein's Where Do Gays Retire. I think you're in both of those groups and have commented several times, and that's how we connected. So thank you very much for shedding a little bit more light on this topic. I know, folks, this is not a complete answer for you, and that's why Michelle is here. If you want a complete answer, go ahead and reach out to her.
Yeah, awesome. Thanks, guys.
Thank you.
Retire abroad, but make it fabulous. The Optimized Portugal Golden Opportunities Fund grows your wealth, plants your roots in Portugal, and after 5 years, you can apply for EU citizenship. Better healthcare, lower costs, and over 170 visa-free destinations. Discover more by clicking the link in the video.
Retiring abroad isn't just about sipping wine in Tuscany or beach walks in Faliki. It's about keeping more of your money in your pocket for longer. Before you pack that Louis Vuitton and the Labradoodle, run the numbers. Check your future country's treaty with the United States, know how Social Security is going to be taxed, and consider shifting your retirement mix as appropriate if necessary.
And remember, we're curious. What will be your main income stream in retirement? Will it be Social Security, your IRA or 401k, Roth, pension, part-time work, or something else? Share with us in the comments. And hey, if you want to see how close you are to your ideal gay retirement abroad, grab your Happy Gay Retirement Calculator using the QR code on the screen with the link in your podcast player or this YouTube description. And then remember, join us next week when we cover the 5 best cities for gay retirees in Ecuador. And then in 2 weeks, we're going to be talking about smart tax strategies for that $6,000 boomer bonus deduction that we mentioned back in episode 607.
And if you love this episode, please remember to like, subscribe, click all the bells and whistles, and share this with friends and family who also want to retire fabulously abroad. And until next time, stay fabulous. If you're not sure where to retire, check out this video on where gays actually retire with Mark Goldstein of the Where Do Gays Retire podcast.